Can you really achieve 5% monthly portfolio growth with the 0 DTE Strangle strategy? Let's dive in. So first, we need to understand how the broker is going to margin this trade. So oftentimes they're going to use a 20% risk array model. In other words, they're going to measure the maximum risk that will be included if there is a 20% drop or a 20% rise in your underlying asset. So another thing that we have to understand that's very important is that as the underlying moves up and down, your margin is going to change. So in today's example, the initial margin is $100,000, but if SPX falls 10%, then that margin quickly jumps to $163,000. So in today's example, we're using SPX, and we're going to sell one call and one put only, so it's only a one lot. And using the 20% risk array, the margin is actually $100,000. So now we're going to take a look at the risk profile, and we can see that if SPX does not move in a short amount of time, then this trade can make $205. So next we're looking at a 10% move down in SPX, which has happened in one day, just so we can see our VAR of the trade, or the value at risk. And we see it's over $47,000 to the downside. We can also see that if SPX moves 10% to the upside, then we're risking over $48,000. So now that we know how the margins are calculated, how these margins can change, and what our value at risk is on the trade, let's see how much the trade can make for your entire portfolio in a period of 30 days. So with a $200,000 portfolio, we can afford to do one lot, and this one trade makes $200 every time it's successful, and we have about 20 days in a month. So if you do the math and you consider that you're going to have some losses, let's say you make money like 78% of the time, well then you're making just over $3,000 per month, which comes out to 1.56% return on that entire portfolio. Now, if you were to double this trade and do two lots for theoretical purposes only, then you could essentially make just slightly over 3% on your entire portfolio. But the problem is it'll start with a $200,000 margin requirement, which would most likely quickly change and increase once you enter the trade and the price of SPX moves, and then you would be forced to close out the trade. So in other words, you can't really make 5% in a month on your entire portfolio with the short strangle 0 DTE strategy. Well, not if your broker's charging a 20% risk array. The only way you can do it is if the broker is charging much less. And now a word from our sponsors. Unlock your trading potential with SJ Options and the Option Colors platform. Gain a competitive edge by leveraging higher order Greeks and consistently capturing volatility skews. Discover crucial options information hidden from 99% of traders. Elevate your trading skills with a complimentary demo and take your options trading to new heights. Ready for a change? Get started today. For some final number crunching, in a scenario where the brokerage margin didn't matter at all, well, to make 5%, you'd have to do 3 lots. In other words, you would be risking about $150,000 of your portfolio, which is about 75% of that portfolio. And the margin would actually be $300,000 on your $200,000 trading account. So that would essentially get you a potential 5% in a month, but again, that assumes that you're going to be winning on 80% of these trades and that none of your losses are going to be anything significant. So that's a wrap. That's how you can achieve 5% on your entire portfolio in 1 month with this 0 DTE strategy. Would I recommend it? No. You have to risk nearly your entire portfolio to do so. Thank you very much, and see you in the next video.